With mortgage rates increasing so quickly up to 5.5%, home buyers are looking for any way possible to get into a home. So recently, I have been asked a lot from my buyers about an adjustable rate mortgage, or an ARM for short, in order to keep their payments low and their interest rate low as well. In this video, I will share with you what an adjustable rate mortgage is, how it compares to the standard 30-year fixed rate mortgage, both what the pros and the cons are of the adjustable rate mortgage, and whether or not you should consider an adjustable rate mortgage on your next home purchase. But first, before I get started, you guys, I want to thank you so much for tuning into this video. My name is Costa. I'm a real estate agent, real estate investor, and entrepreneur here in Northern New Jersey. If you get any value or enjoyment out of this video at all, please smash that like button down below. Would truly appreciate it. It really helps me grow on YouTube. So what is an adjustable rate mortgage? An adjustable rate mortgage, or an ARM for short, ARM, is a home loan with a variable interest rate. With an ARM, the rate is fixed for a certain period of time, but after that predetermined period of time, the rate periodically changes thereafter. When it changes, it usually adjusts based on a specific index, like the LIBOR rate or the federal funds rate, plus a spread, a certain spread. Let's say the LIBOR rate plus 1.5%. So if the LIBOR rate was 3%, your interest rate would be 4.5%. Generally for ARMs, you hear about 3-1, 5-1, 7-1, or 10-1 adjustable rate mortgages. There are other options out there and other adjustable rate programs, but these are the main ones. So the first number is the amount of years that you actually have a fixed rate. 3, 5, 7, or 10 years. And the second number is the period of time after that fixed rate period that your rate resets. So on a 5-1 ARM, for 5 years, you have a fixed rate. And then after those 5 years, every 1 year, the second number, is when your interest rate adjusts compared to, that index that we talked about. So how does an ARM, an adjustable rate mortgage, compare to the standard 30-year fixed loan? Well, a 30-year fixed mortgage, fixed loan, is exactly what it sounds like. It's a fixed interest rate home loan mortgage for 30 years, no matter what. Your payment will always be the same for the next 30 years unless you refinance or something like that. The 30-year fixed rate mortgage is by far the most common home loan that home buyers get because it provides predictability in payment and stability in interest rate and payment, which is very important to almost all home buyers, especially when dealing with your primary residence. More on that later. 30-year mortgages have become even more common than they were before the past few years, since interest rates have been at all-time lows. Because for basically almost everyone, it made sense to lock in that 2.5% or 3% mortgage rate for the next 30 years. I mean, why not? It's literally almost like free money. But with the Fed hiking interest rates recently in order to combat inflation, as well as home prices still at all-time high levels and home inventory still at all-time low levels, home buyers are doing anything they can to try to get into their dream home, or any home for that matter. So what are the pros of an ARM? Well, with an ARM, you are able to get a lower interest rate compared to a 30-year fixed rate, at least for a certain period of time. You are also able to qualify for more purchasing power when using an ARM compared to a 30-year fixed. So if you think the housing market is just going to go up from here and you could build a lot of equity in the house in a short period of time, you may want to consider an ARM. Or if you believe that interest rates are only going to go down from here and you'll be able to refinance in the future at a lower rate into a 30-year fixed, you may want to consider that ARM as well. Or lastly, if you don't plan on staying in that house for longer than that set period of time at the fixed rate for an ARM, you may want to consider an adjustable rate mortgage in that scenario also, but because you plan on moving out before you even get to the end of that fixed rate. So you're never going to have to deal with that adjustable rate in the future anyway. But notice that I use the terms if you think or if you believe a lot in regards to talking about the pros of an adjustable rate mortgage. That brings me to the cons of the adjustable rate mortgage. The cons of an adjustable rate mortgage are very important to understand if you're even considering using an ARM on your home purchase. And the biggest reason for that is the risk involved involved. Yes, an adjustable rate mortgage does give you a lower interest rate for a period of time, but in order to get that short-term saving on the interest rate, you are taking on some future risk that you need to be aware of. After that 3, 5, 7, or 10-year period of a fixed rate on the ARM, the interest rate on your mortgage, as well as the payment in general, is completely unknown. It could be lower in the future, but most likely it will be higher. And that unpredictability could really put you in a bad spot, especially when dealing with your primary residence. So should you get an adjustable rate mortgage? Well, if you weren't able to tell already, I'm not super keen on the adjustable rate mortgage. In fact, if you're planning on using an ARM on your primary residence, I would say just no, completely avoid that at all costs, because the short-term reward is not worth that long-term risk of your monthly payment on your primary residence skyrocketing to a level that you can't afford. Some say you could or even should get an adjustable rate mortgage if you're not even planning on staying at the home longer than that fixed period of time, let's say 3, 5, 7, or 10 years. But frankly, even in that scenario, I would advise against the adjustable rate mortgage. Because number one, your plans can always change. I know if you asked me 5 years ago where I'll be 5 years from now, I would not be making a YouTube video about adjustable rate mortgages, that's for sure. Plans change. And also, if home values go down, if we hit a bad economic cycle, we hit a bad recession, and home prices go down, home values go down, which is possible. We've had such a big run up. Don't listen to every realtor out there saying home prices can only go up. It is possible that they go down in the future. It is likely that either A, you'll be underwater on your mortgage and owe more than it would be worth at that time, or B, your monthly payment skyrockets so high that you're not able to afford the payment anymore. I love good debt on real estate, right? But for your primary residence, it is super important to have that predictability and that stability to know that, hey, I know what I'm gonna have to come up with every month in order to keep, me and my family in our home. So after all of that, you may be asking yourself, who should be considering an adjustable rate mortgage? Because adjustable rate mortgages are not all bad. I wanna make that clear as well. They do get a bad rap because they were used pretty prevalently during the 05, 06, 07 housing bubble, let's call it, as home prices were going up very quickly and a lot of home buyers were trying to purchase homes as the home values were going up, and they were putting very little down. They didn't have good credit. That's what was called the subprime mortgage crisis, which led to the 2008 financial crisis. I'll make a video on that in the future at some point. I don't want to get too much into the weeds on that, but that is why the adjustable rate mortgage does get a bad rap, and some of it rightfully so. But there are some uses. And the number one use for an adjustable rate mortgage, or who should be considering an adjustable rate mortgage, is really just strictly investors, in my opinion, like house flippers or new home builders. Because flippers and home builders know almost for certain that they're going to be out of that property before that adjustable rate term even becomes an issue at all. So the level of risk is reduced significantly for that type of buyer, the investor. And using an ARM, an adjustable rate mortgage like that, could save the builder or the investor a lot of money on carrying costs and loan costs as well. Plus, this is on an investment property and not a primary residence. So if shit hits the fan, the investor can just walk away from the property. It's much easier to walk away from an investment property than it is from the home that you and your family live in. Trust me, you don't want to be making any sort of risky decisions based on your primary residence. I do work for the bank on REO properties, and we deal with evictions. We just started doing some more recently, actually, and all these people, you just can't believe, you feel so bad for them, but also at the same time, they just made horrible financial decisions using their primary residence, taking out money, taking out equity in a line of credit, or getting a second lien mortgage out, a cash out refinance. You don't want to be taking too much risk on your primary residence at all. Now, that being said, a home equity line of credit is not always a bad thing. It can be used for a very good thing. Check my video in the description as well as the link up here on the home equity line of credit and my experience with it. But you don't want to be putting yourself in a bad spot on your primary residence, and that is the number one reason why I would really advise against the adjustable rate mortgage, using an adjustable rate mortgage for your primary residence. That is it for today, guys. Thank you again so much for watching. I truly appreciate it. Let me know what you think in the comment section down below. Are you considering an ARM? Would you consider an ARM? Have you gotten an adjustable rate mortgage in the past, and what was your experience with it? Also, Let me know what you think if the adjustable rate mortgages usage levels starts coming up here as interest rates go up. Is that making you more bearish on the housing market? Does that mean that there's more risky lending going on? Let me know in the comment section down below what you think. And yeah, until next time, guys.